Hi there. I was asked to put together an explainer video to kind of walk you through the premium finance structure to see if it makes sense for your overall life insurance portfolio. And in order to get there, I kind of need to set the stage for what types of insurance policies exist in the marketplace today for someone your age. And I did this for you, as well as we did this on your spouse as well. So the initial one's going to be a single life design. And the second set of data points I'm going to go through is going to be based off survivorship structure or a two-person policy, otherwise known as second to die. So in order to begin, let's begin with term insurance. So if we're going to do a $10 million term insurance policy for a 56-year-old individual today in the state of North Carolina, preferred non-tobacco, a 10-year level term policy would run almost $13,500 a year for 10 years. For 20 years, it would be $23,000 a year. And for 30 years, it would be $52,000 a year. And so term insurance is good if we're covering a very specific unit or section of time. Not so good if we're trying to cover an indefinite time period, because the way these are priced, they're priced to not pay a death claim. 98% of all term insurance policies ever written have expired after the term or been surrendered at some point during the term and have never paid a death claim. Only 2% have, meaning the majority of the premiums that get paid into life insurance policies just go to the life insurance company and never come back to the client or the individual. I mean, there's ways you could structure a term insurance policy to have some sort of return of premium component to it, but tend to not be the best choice if we're looking for a long-term solution, which leads us to permanent policies. And there's three types of permanent policies. We can do indexed universal life, we can do whole life, and we can also do variable life. Now, it all depends on your tolerance for risk and what you're trying to accomplish. Most of the time, people like safer permanent policy options, and so we end up doing some type of indexed universal life, or we end up doing some type of whole life, and that's where we're going to spend my time focusing. And so for a $10 million policy, again, focusing on a $10 million policy, Symetra, Pacific Life, John Hancock, three very reputable companies. From an indexed universal life insurance perspective, $177, almost $178,000 a year, $192,000 a year, or $196,000 a year for 10 years. And those premium payments are after-tax premium payments. So that money's invested, you have to divest it from where it is, you have to pay the capital gains to then pay the premium, or you have to earn the income to then pay the tax to pay the premium. These are after-tax premium payments. And if we were going to do whole life is requiring substantially more based off of the structure of these types of policies, $600,000 a year and nearly $850,000 a year. And when you look at it as an asset class inside of your overall portfolio, you know, the whole life is running shy of 5%. The index universal life IRR, the internal rate of return, is running just shy of 6%. But when we apply leverage and we use bank financing into the design, if we're using it as an alternative asset class in your portfolio, the internal rate of return on the premium finance life insurance is 12% on a pre-tax or a tax-free equivalent. If we're going to use a pre-tax equivalent, we're looking closer to 15 or 16% as an IRR, meaning dollars you pay out of pocket relative to the dollars you receive back, 12% on a tax-free basis. We also have the ability to set up the premium finance structure so that you can start to take potential tax-free distributions and not necessarily have to wait for just a death to occur. But if we were doing this strictly for death benefit only, this will set up for the tax-free distribution as well. We have the life insurance details. So columns 3 through 7 set up the life insurance details. We have policy premium, policy account value, cash surrender value, gross death benefit, and any potential loans or withdrawals that we're taking out of the structure. And this was taken directly from the life insurance carrier. And this is structured in a way for a 56-year-old female maximum efficient funding, getting as much money into the policy as possible for the first 10 years that the IRS allows, so that we don't have to put any more money in thereafter. But to put in $893,000 a year out of pocket probably sounds less than attractive, because you have money, you're good at making money with your money. So why would you divest really good earning dollars to put into a permanent life insurance policy that's only going to provide about a 6% yield or IRR on your investment, where if you can leverage that and you can use bank financing, it turns it back into that 12 to 15% IRR that I was mentioning for you. So columns 8 through 12 is where, or excuse me, 8 through 13 is where we introduce bank lending or bank financing to the design. So instead of you paying the $893,000, we're going to have a bank finance that every single year for you on a tax-free basis, because the loans are tax-free. You don't have to report loans as income on your tax return. Additionally, we're going to have the lender finance the interest into the design. That's column 10. And that dollar amount is driven by the interest rate in column 9. And as you can see, we put varying rates and increasing rates into this design. This is a very well-stressed loan interest rate model for the next 10 years. No one has a crystal ball. No one knows where interest rates are going to go. But most of the forward-looking curves suggest interest rates are going to go down over the next 12 to 18 months and then stay down for the foreseeable future. We actually show them going down and then going back up to even higher what they are today. Very conservative design. And then we're holding rates steady at 4.5% going forward in the 11th year. And you'll see in year 15, we're actually going to take the bank out of the equation. So the interest rates here that we're projecting at 4.5% don't even really matter in the design. But again, bank is going to finance the premium. Bank is also going to finance the interest that the premium or the loan that they have. And we show you paying $50,000 a year out of pocket for 10 years. That is your out-of-pocket outlay. That is your out-of-pocket amount that actually allows us to calculate a potential internal rate of return projection. So again, if the bank is financing the premium plus the bank is financing the interest, that's your outstanding loan balance, minus your out-of-pocket payment to pay the interest and or the loan down, leaves an end-of-the-year loan balance in column 13. And that end-of-the-year loan balance in column 13 is no personal guarantee, non-recourse, or extremely limited recourse to just the collateral that's needed to be pledged. And again, from the lender's perspective, they're loaning you $893 plus interest of $40,000. They're taking a lien on the cash value of the policy, which is column 6 in this example. So year one, there's an outstanding loan of $892,000 against a $258,000 asset. So there's a shortfall of $633,000 in year one that the bank needs you to true up, pledge, or cure before they're going to finance you any money. And so that is done in cash, cash equivalents, marketable securities, or letters of credit. We could discuss on another call what that would look like. And so we do this every year: wash, rinse, repeat. Premium finance, interest finance, end of the year loan balance, peg it against the cash surrender value of the policy, which is the portion of the policy that the bank could liquidate in the event of default, leaves a gap. That gap is column 14. And based on the projected illustrated rate of 6.65, which we can have a discussion about that and how that is a most likely conservative number, against the borrowing rate from the policy, which again is also most likely an extremely conservative projection, we're looking at your peak collateral being roughly $730,000 in the 5th year. And by the end of the 11th year, there's no more additional gap collateral required. And why is because at that point, the cash surrender value of the policy itself is larger, greater than the outstanding loan balance that's inside of the policy. So 12.8 million is larger than 12.5 million, right? And so now there's no additional collateral needed from an outside source. It's all fully insulated by the policy. And then column 15 is the net death benefit that would go to your beneficiaries, your survivors, your trust, your heirs upon your death in a tax-free lump sum. And again, that's roughly the $10 million that we're starting at today, which is the solve that we went for in this design. And if we were going to add a tax-free distribution component to the design, it doesn't change the math in the early years. The only math that it changes is after the loan has been exited in this example and we start to take a distribution from the policy, the suggestion is, or the illustration says from the insurance carrier, that we can take nearly $258,000 a year income tax free for the rest of your life from the design. It goes all the way through your age 120 in this example. But take a tax-free distribution of $257,000 while still maintaining roughly a $7 million tax-free death benefit for your beneficiaries. And the other example is nearly a $10 million death benefit, but when you add in taking the tax-free distributions of $258,000 a year, it drops that down to roughly a $7 million benefit for your beneficiaries. This is a very solid design, a very attractive design. It's not without risk, it's not without assumptions, and without some safety measures that need to be put in place, and understanding the risks, the collateral risk, the interest rate risk, the interest crediting risk, and the death benefit risk. But we need to understand all of those things, which we're confident we can get you there. And then we have the second to die policy, which is based on 2 lives. So I have a 56-year-old female and a 67-year-old male. And when we look at those types of policies that exist in the marketplace, we're looking at an indexed universal life, or we're looking at a whole life. And again, for a $10 million initial death benefit, we're looking at nearly $186,000, $197,000, $200,000 if we were going to use John Hancock Pacific Life Nationwide's indexed universal life, or if we were going to use New York Life's whole life contract, $500,000 a year for 10 years. Same thing, right? After tax dollars, you have to divest it to pay the premium. Otherwise, we can look at a Pacific Life policy, and we can look at financing the premiums for 10 years, where your out-of-pocket outlay is $130,000 as opposed to the cheapest route of $186,000 if you're going to self-pay the premiums. And again, everything from a mechanical or fundamental standpoint is set up the same way. Columns 3 through 7 are the life insurance details. Column 8 through 13 are the bank lending information. Column 12 is your projected out-of-pocket payment. But column 14 is your projected collateral gap, which is relatively nothing in all years except for year 1 of $17,000, leaving a $10 million death benefit in most years, dropping down at the most critical mortality phases to $7 million, and then climbing back up to $8, $9, $10 million and beyond. And this is on a second to die policy. So the conversation to be had is, do we do single life on you? Do we do second to die survivorship on both of you? Do we do a combination of both? And I don't think it's an either or conversation. I think it's an and conversation. So hopefully this has been helpful for you. It's a conversation starter. It's an explainer video. Please watch this multiple times, line up your questions, and let's set up a time to discuss this in detail so that we can have a meaningful conversation. Talk to you soon.